else for coming out today. If people came out in the morning and wondered who are all these people in suits here today, that means that we're part of the socially responsible investment community. If you guys could just raise your hands for a second. So as Nima said, I'm Leslie Samuelrich. I'm the president of Green Century Capital Management. And I'm standing here today with members of the financial community in support of the Harvard students, the alumni, the staff, and all the other members here to support the divestment campaign. Opponents of divesting have said that it's too risky, that divesting is too costly, and that shareholder advocacy is the better way to go. Running a firm that invests in only fossil fuel-free ways, I'm here to say that it just doesn't add up. And now we're going to talk about the very scintillating financial reasons that it doesn't. First, let's talk about returns. In study after study since the divestment campaign began, investment analysts have provided data that shows that fossil fuel-free investing does not have a negative financial impact. It started when you're looking at a period of either 10 to 25 years from the very first study that came out by Aperio Group to the most recent study from Advisor Partners, you'll see that eliminating fossil fuel companies from your portfolio does not have a negative impact and in fact may bring financial benefits to you. Okay, there we go. Thank you. Okay. It's a little hard to make the financial stuff really that exciting, but okay. The first benefit, though, to divesting will be dividends. For our non-suit people, that's the part of the company's earnings that may be distributed to the shareholders each year. But do you know what the boards of directors of oil and gas companies are doing with those earnings right now? No, right? So instead of distributing the majority to their shareholders, they're pouring them into expensive exploration and drilling projects. So in 2013 and 2014 alone, the top 200 fossil fuel companies had adjusted capital expenditures of $640 billion. And of that $640 billion, they only paid $126 billion in dividends to the shareholders. That's a big difference in what they could be paying to our shareholders. And on top of that, the company spent billions on projects like offshore oil drilling, opening up drilling in the Arctic, and other dangerous and expensive drilling and exploration projects. It even caused the Wall Street Journal, not a huge fan of divestment at this moment, to run a story called "Big Oil Companies Struggle to Justify Soaring Project Costs." So might not the institutions want to avoid an industry that is only distributing to its shareholders 20% of its earnings every year and spending the rest on projects with costs that may never be recovered? A second reason, build momentum up, right? A second reason, while opponents claim that divesting is risky, they are ignoring the core fact that the energy sector is one of the most volatile industries around. So it's not even me or the other socially responsible investors are saying that, but a very mainstream analyst, they have come out and said this time and time again. Since 2005, the energy sector has been one of the most volatile and risky. The third reason, the third reason is that over the long term, these companies may have stranded assets. And institutions like Harvard, who are concerned with their long-term returns, may in fact benefit from divesting so that they are not stuck with these devalued or stranded assets. All right, just a few more minutes. So with all this data, the financial case for investing, for fossil fuel-free investing appears strong, even formidable. But still, too many institutions are instead digging in and saying that they want to use their influence as a shareholder to influence fossil fuel companies. Green Century and many of my colleagues here Other firms such as Trillium Asset Management have used shareholder advocacy very successfully in the past, but not with fossil fuel companies to reduce their core business. And here's why. There is no track record of success. None. Zero. Even the Rockefellers could not get oil and gas companies to change, so much so that they ended up divesting as well. It is unlikely that there ever will be a success with shareholder advocacy because simply it is not designed to change the core business of a company. It can make many other achievements with other industries, but in fact, a kind of resolution that asks an oil or gas company to change its core business is not even legally allowed on the ballot. And third, dirty energy companies are not going to lead us to a clean economy. Do we really think that the companies that spent decades denying climate science, funding anti-climate activists, nope, that's not right. I'm going to start again. Do we really think that energy companies that spent decades funding campaigns to deny climate science and say have no plans to stop drilling now are going to lead us to a clean energy future? No, exactly. So, while divesting certainly may take some time for some institutions, there is a clear path forward. In fact, again, my suit friends, will you raise your hands? All of these firms here, whether you're working with institutions or with individuals like Progressive Asset Management, manage money that can be invested fossil fuel free. So to say that there is no path forward is just wrong. There's a clear path forward, and it's the path that Harvard and other institutions should be following for financial reasons, for the reasons I outlined. Okay, so let me wrap it up. Bob Massey told me I should end strong, so let me go back and recap the beginning. Opponents of divestment say it's too risky, that divestment is too costly, and that shareholder advocacy is the better way to go. I and the rest of us are here to say that this does not add up.